the Roaring 20s, and then the Great Depression in the 1930s. And in this video, the theme is to cover how the concept that holding long term is not always a recipe for success. For example, if you would have bought stocks in the mid 1920s, by 1933, you would have lost 90% of your money. And not only that, for those who would say, well, just hold long term, you would have held long term another 26 years, well into the 1950s, just to break even on that initial investment. 26 years from the bottom, just to break even on that initial investment. So if you were 20 years old, well, you would have been 46. But if you were 30, or if you were, let's say, 40, you would have been 66. If you were 50, you would have been 76. So it just, to me, it just doesn't quite add up. I mean, why wouldn't it make more sense just to sell on the way down, even if you would have, you know, even a loss of 20% or 30% or even 50% is way better than 90%, and then have a, you know, look at what's a better way to deploy that capital that you would have had to wait another, potentially from the beginning of that fall, another 30 years just for it to break even. You didn't even make any money on it. And then the next example is 1965. If you would have bought stocks in 1965, by 1980 you would have lost not 90%, 93% of your money, and would have had to hold until 1997. So for example, if you were 30 years old in 65, say, you would have had to hold another 32 years till the point you were 62 years old to 1997 just to break even. But the difference is that in that era, 1980 to 1997, there was a level of inflation that was not existent in that previous era, right? Because we're talking about 1971, as I covered in a previous video, the U.S. was no longer on a gold standard, so inflation was, you know, given the go-ahead to run rampant. And $1 in let's say 75, you know, was worth potentially 25 cents by the end of the 90s, and let alone now. I mean, $1 then is worth 10 cents or 5 cents now. So the value of each dollar is consistently depreciating. So I think that's something that is very much overlooked, because people say, oh, well, you know, whether their money that they're earning is going to a 401k or into a pension, without understanding, number one, that this whole financial system is interdependent on a variety of factors that prop it up. For example, bond prices, the fact that unfunded liabilities, which again, pensions and 401ks fall into that category of unfunded liabilities, meaning that those are sums of money that are expected to be paid out at a later date, but aren't actually included on the ledger or the balance sheet, you know, year over year. But that is money that is owed. So it's a very precarious situation that we're in, and I think that one of the biggest ways that people lose hard-earned money is by just taking for granted that's just because stocks go down, that they're going to go up again. And not only are they going to go up again, but they're going to go up past the level at which, you know, an entry was made. In other words, at which the buy price was. So if somebody bought at a given price, well, it's a given that it's going to go past that price and I'm going to make money. Well, not necessarily. Again, give it those two examples that I just gave you. You would have bought stock in the 1920s. By 1933, you would have lost 90% of your money. If you would have bought stock in 1965, by 1980, you would have lost 93% of your money. And in both cases, in Great Depression case, it would have taken you from 1933, 26 years, well into the 1950s, well into the post-World War II boom to recover your money. In the second case, 1965, bought stocks, sold, or let's say just held into 1980. Well, if you would have sold in 1980, you would have lost 93% of your money. If you would have held, you would have had to wait another 17 years just to break even. And the rate of inflation was so high at that point that you wouldn't actually have been breaking even. You would have lost money even though on paper, oh, I broke even. Well, why would you want to wait, you know, basically from 1965 to 1997, over 30 years just to break even? That does not seem like a good investment. So some of these myths, you know, in investing, I feel like need dispelling, and a lot of people are, especially in today's market, it's not just an up market. This market is having a lot of problems, and it's very important to look at what's actually going on, and just to look at history and to learn from it.